Patience is the capacity to accept or tolerate delay, trouble, or suffering without getting angry or upset. More than anything else, this is one of the most important characteristics of a good investor because sometimes investing feels like torture. In this case, Chinese Communist Party torture. So, let's take a look. The Chinese Communist Party's recent clampdown on the booming private education industry has shocked even some of the most seasoned China watchers. Investors are rethinking how far Xi Jinping's Communist Party is willing to go as it tightens its grip on China's economy. It seems that a day cannot go by without the CCP coming out with another regulation. In the latest, the government has banned a swath of education industries from making profits. This spread from the education industry to the tech industry and beyond. Property management and food delivery companies were also among the biggest losers on Monday since Beijing is tightening rules for these sectors too. The losses in Chinese tech and education stock now exceeds $1 trillion since February. The sweet and sour question at every trading desk from Shanghai to New York is, where will regulators strike next? And are the markets properly discounting this new regulatory risk? While some investors like me say the sell-off has created buying opportunities, there's plenty of time and room for more surprises, especially for international investors. All 10 industry groups in the MSCI China Index posted declines as the gauge sank 5.6%. This is the strongest sell-off since March 2020. It's now trading at about 1.4 times book value, the biggest valuation discount on record relative to global peers. In the U.S., the Nasdaq Golden Dragon China Index plunged 7% Monday to close at its lowest level in 13 months. This gauge tracks 98 of China's biggest firms listed in the U.S. and has lost $769 billion in value since reaching a record high in February. Everyone's in the crosshairs, and this is certainly very difficult to navigate. When you have an investment that over the weekend can basically evaporate simply by an edict by the CCP, how do you plan for that? But regulatory risk is nothing new in China. And remember, the U.S. government is taking a hard look at our own tech sector. So don't think that the U.S. market is immune from these kinds of shenanigans. Right now, it may be a bit early to know whether the Chinese government's attitude toward the private sector has permanently shifted, because in some ways the CCP has made it easier for companies and investors to access capital markets in recent years. Yet the Chinese crackdown is a wake-up call for investors who've overlooked Chinese regulatory risks in recent years. Many high-growth Chinese companies have already dropped by half in the past few months, and many investors have started to panic. And this tells me it's time to look for good opportunities. However, at the same time, many other investors will take a no-touch approach. If you do look at Chinese investments, be sure to be selective. However, like the pandemic and negative oil prices, this too will pass. So be patient. And for today, that's ChewDog Charts. Thank you.